Hi, my name is Allan Madan. I'm a chartered accountant and tax expert in the Mississauga, Toronto, and Oakville regions of Ontario, Canada. Today's video is called the 5 most common personal tax mistakes to avoid. First most common personal tax mistake to avoid is claiming RSP contributions in the wrong period. It's really important that any contributions made in the first 60 days of 2012 be reported on your 2011 tax return. While you may be thinking, I don't want to deduct those RSP contributions made in the first 60 days of 2012 on my 2011 return, but you still have to report it, and you have the option to carry forward those deductions if you want to the subsequent year. The second most common personal tax mistake to avoid is claiming deductions and credits on your personal tax return without official receipts. The CRA can ask for those receipts at any time, and if you don't furnish them, they will disallow the deduction and credit plus charge interest and penalties in addition to the tax. Also, you'll be flagged for audit in future years. The third most common mistake that you need to avoid is missing out on employment expense deductions that you're entitled to. By completing Form T2200, called Declaration of Conditions of Employment, you can deduct employment expenses on your return. The most common employment expenses include car, travel, home office expenses, meals and entertainment, and expenses earned for earning commission income if you're a commission salesperson. The fourth most common mistake to avoid is forgetting to report your income slips on your personal tax return. A lot of times, banks, insurance companies, and mutual fund companies don't issue the T-slips or income slips on time, and you may not get it until the end of March or middle of April. So it's really important that you gather all of your slips from all of your financial institutions and report them on your tax return. If you forget, the onus is on you, and you will be penalized for not including that income. The fifth most common mistake that you need to avoid is improperly reporting your retiring allowance that you received if you were terminated or left your job. This is probably the most mishandled of all items that I've seen. When you receive a retiring allowance, there are 2 amounts. One is the eligible portion, which can be transferred to your RRSP completely tax-free without affecting your RRSP limit, and the other is the non-eligible portion. With the non-eligible portion of your retiring allowance, you have 2 options. One, you can take the amount and put it in your bank. Taxes will be deducted at source. The second option is you can file an election to have it transferred to your RSP without any tax taken off to the extent of your RSP contribution limit. Because this area is very complex and the dollars are large, it's important that you consult a chartered accountant. I hope you found this video useful. For more great tips and tricks, please visit my blog, the URL for which is shown at the bottom of this video. Also, get access to your free report, 20 Tax Secrets on How to Beat the Taxman by Allan Madan, yours truly, the link for which is shown at the end of this video. Thanks a lot for watching, and see you next time.